Good morning. So today we shall learn module 3 product development under product lifecycle management with continuation with the previous lecture. So today we are going to learn estimating market opportunities for new product or new product development. So basically for estimating the market opportunities, so we need to understand five major uh, things here. It's number one, the market size. Next, market growth. Next, the competition, profitability, consumer and product type. So what are these and how these factors affects the estimating market opportunity for a new product? So that we shall study one by one. One, market size. The first and most important factor to consider while determining market potential is the market size of the product. So market size is the total market sales potential of all companies put together. So if you plan to launch a new soap or shampoo, for example, so then all the different companies will be our competitors. And the combined sales of soaps, including branded and non-branded products, is our complete market size. That's how we can define the market size. So one more example, if you are a dealer of industrial ball bearings, so then all the companies which are in manufacturing are potentially our customers. So if you find out the number of industries in our region, that is the ideal market size which can target when launching a new ball bearing product, right? So that's how we need to identify the region and the market size. So depending on market size, we can manufacture or launch the respective product. The best way to get market size is to contact local research agencies. So if it is a small business, so if it is a larger business, then market research data from companies should be collected. So determination of market size is the first step to determine market potential. So whether we have proper market for selling our product, so that we need to estimate first. Next, market growth rate. So we need to identify the market growth rate. For example, the personal computer market as compared to laptop market or smartphone market is declining nowadays. So that we are seeing. So if you are a company which makes personal computers, then you have to aware that you are entering and declining market. So first we need to study the product growth in the market. Instead, if you have the potential, why not enter the laptop market or smartphone market? That's how we need to estimate the market first. The ongoing trend in the industry is important as it can forecast the future of the product. One more example, initially books were all the rage, but now they have been replaced by e-books and there is hardly any need for physical books. Though people still love to read them, but only few of them are willing to read books physically. So nowadays many of them have switched over to e-books. So when we study market growth, we have to forecast based on the differences between product line extensions and a completely new concept in the market. That is, we need to think of new concepts in the market. So the market growth rate is subjective and it depends on the type of product we are going to launch. Next is the profitability. So determining and forecasting the profitability is important to understand the market potential. If the business is going to give low profitability, then the volume need to be high. If profit is lower, then the volume of that should be high. Or if the business is going to give low volumes, then the profit need to be higher. For example, industrial goods. So how to calculate this profitability? So calculation of profitability to determine market potential can use three main elements. So those are: number one, return on investment, return on sales, return on net assets, return on capital employed. So these are the major three elements which are required. Any of the calculations mentioned above can be used to calculate the likelihood of profitability and to determine how profitable the industry is going to be. So based on this, we can think how much profit can we get, and then we can think of proceeding further. And next is competition. So as we know, for any industry, the competitors will be available in the market. So we need to know and understand the competition in an industry to determine the market potential for the product we are going to launch. If the industry has high competition, the entry barriers are going to be high, and at the same time, establishing ourselves will require deep pockets. That is, we need to invest more. Then we need to lower the price of our product even though we are giving higher value. This requires that we have enough money to take hits till the time competition leaves the market. This is exactly what happens when the top brand enters industry which are dominated by smaller players. Today, small retailers are suffering under the brunt of large multinational sellers. So this does not mean a small business have stopped establishing themselves. They are using different strategies to attract customers to their business. So one such strategy is good customer service, which is missing in large corporations. So the last point is product and consumer type. So initially we need to understand that our product is a repeat buying product or one time sale only. So that we need to analyze first. In the above examples, soap and shampoo is a repeat buying product, that is for every day-to-day needs. So all people will be depend on the soap and the shampoos. They need to buy, right? One more example, but once a customer buys a refrigerator, he will need another for the next 10 years. So if you take example of refrigerator, so we may not buy it regularly, right? So we may need that only when it undergoes any damage like that. So in his whole lifetime, he will buy 8 to 10 refrigerators at a max. So one customer can buy maximum 8 to 10 refrigerators throughout his lifetime. But in a year, he may buy 40 to 50 soaps individually. So this we need to understand first. That's 300 to 400 soaps per individual in their livelihood. So minimum they will buy 300 to 400 soaps. So multiply that by a billion and we can understand the market potential of soap factory or soap industry. So they need to manufacture more and the customers will be more, but even though the cost of the product may be lesser. So how frequently is the product going to be bought again? Many toothpaste companies actively push the customer to brush twice in a day. So they mislead us to brush twice a day. So what is the reason behind this? So one of the reason is that customer teeth will be better. So they tell that it is the customer teeth will be better. But another reason is that the toothpaste will be consumed faster and they will buy another toothpaste soon. Hence they push for brushing twice a day. So if a person brushes twice a day, automatically the toothpaste will end fastly. So then you need to buy a new toothpaste. So that's why. So they insist us to buy or to brush twice a day. One of the reason. Next we shall move on to example of determining market potential. So how to determine the market potential? One of the example is here Chinese cuisine restaurant. So for example, I want to launch a Chinese cuisine restaurant in my locality. So I determine the market potential as follows. So how to identify, can I go for this or not? Number one, market size. So first I need to think in my location. So what is the market size? So I have 2 lakh people living in my locality. Assumption. They are of different demographics, but with some market research, I found out that many of them are young adults. So young adults will be attracted towards the Chinese restaurants that we know. Next, market growth. So whether our growth will be good or what, how to identify that? As my region has even more apartments and buildings coming up, so that we need to identify. So more apartments and buildings are growing up and the market is going to grow instead of decreasing, obviously. So more people will acquire the apartments and buildings, so then automatically people will rush towards the nearby restaurant, so our market growth will be better. Next, profitability, whether this is profitable or what. So I have an idea of the purchase being kept or prices being kept by competitors, and at those prices I will definitely earn a good margin. So we can study the nearby restaurants and what prices they have been kept for the dishes. So by that we can reduce this price and attract the people. Next, competition. Strong competition from local Chinese restaurant. But I believe my cook and experience is better than him when it comes to servicing or serving Chinese food. So we can attract people with a good service. Finally, the product and customer type. So it is going to be a repeat business because customers who like my food are more likely to come again and again. So each customer will be important because I am in the food industry and a single mistake can lose me a lot of customers as well as my reputation. So this is a continuous repeat business. So we need to maintain a good relationship with the customer. So what this mean actually, with these 5 points, by analyzing these things, we can think of the market potential and we can estimate for a new thing over there. So with the above analysis, I can safely say that I am better off with the launch of restaurant and that the market potential exists. Similarly, we can perform a statistical analysis of our product or service which we are going to launch. So and come to decision which regards with regards to the launch of the product. So whether the product can be launched in that locality or area, so that we can decide. So by doing this kind of analysis. Next, new product financial control. So what is this new product financial control? A new product is a result of the various activities from different functional perspectives such as engineering, manufacturing, testing, marketing. It is important to plan the investments for making the new product and control the cost carefully. So how to invest for new product? So there we need to think of investing or with the different activities in the company, right? It may be engineering, manufacturing, testing, or marketing. All areas we need to invest financially. So new product development requires a more sophisticated and detailed business analysis that helps to determine various costs involved in the proposed new product development and forecast profits from the product in future financial years. Estimations. Number one, estimate the present financial status of the company. What is the current financial status of the company that we need to estimate first? Next, financial feasibility is analyzed by developing cost estimation based on designer's idea. So what could be the actual cost of the product that we should analyze next? Next, investment required at each stage of product development is estimated. At different stages, what is the amount of cost required? So that we need to estimate first. Next, framing the cost benefit discussions need to take place between the product development team and senior management to move the product through the developing processes. Next, estimate the total cost involved in all stages. Finally, analyze the cost of various risks associated with new product development and launching and estimate feasible market share and forecasting the demand. So with all this estimation, if you are okay with this and still the company is capable of manufacturing new product and financially it is capable, then only we need to proceed for new product. Next, financial control techniques. So how to control the cost occurring during new product development. So financial control is a control of financial resources as they flow into the organization, that is the revenues, shareholders, investments, etc. are held by organization, that is working capital, retained earnings, etc. and flowed by the organization, that is expenses. So this type of control method aid managers in acquiring, allocating and evaluating the use of financial resource. For example, cash, accounts receivable, accounts payable, inventories and long-term debit. These methods also enable managers to achieve acceptable liquidity, solvency and profitability standards. So what are different techniques available? Number one, budgetary control. What is meant by budgetary control? So definition of the same. Budgetary control is a system which uses budget as a mean of planning and controlling all aspects of producing and selling commodities or services. In other words, budget is an estimate of future needs arranged according to an orderly basis covering some or all the activities of an enterprise for a definite period of time. So we need to finalize the budget. That is what are the expenses which will be occurring throughout the manufacturing of the product. The technique of managerial control by budget is known as budgetary control. So how do we manage that? It is applied in a firm to evaluate the performance in terms of budgeted goals. Objectives of budgeting and budgetary control: to predetermine in capital expenditure of a business, to plan and control the income and expenditure of the firm, to operate various divisions, units, departments and cost center efficiently and economically, to smooth out seasonal variations in production by developing new product to obtain a more economical use of the capital. So that is budgetary control. And next technique is return on investment, ROI. It is a performance measure used to evaluate the efficiency of an investment or compare the efficiency of a number of different investments. Return on investment tries to directly measure the amount of return on a particular investment. What is the amount of returns we are getting relative to the investment's cost? To calculate return on investment, the benefit or an investment is divided by the cost of the investment. The result is expressed as a percentage or a ratio. So we have an equation for return on investment is equal to net profit before investment and taxes divided by total investment into 100. So return on investment is the end product of a series of statistical measures representing the various phases of a company's operations that contribute to this ratio. Expecting healthy returns on new product depend on overall economics of the business. Next, break-even analysis. So what is this break-even analysis? It is a financial control technique widely used to determine the number of units the business need to sell in order to avoid losses. That is, in which areas so we're getting more profit or the sales rate is more. So at those areas we need to extend our marketing strategies. And the areas where we are losing, so we need to slightly reduce the sales at that locations. So this can be found by evaluating the break-even point by using a graphical method as shown in figure by using as shown in figure or by using the formula below. So here the formula is break-even point is equal to fixed cost divided by price per unit minus variable cost per unit. So we can check out here. So this is a break-even point where we are moving towards profit here and this is towards the loss, right? So here this is a fixed cost. This is the actual cost happened and this is variable cost which is slightly varying. This is the total cost and total revenue achieved. So here we have x-axis unit sold and y-axis the sales. So as the sales increases, so we can increase our sales with in different units. So obviously the total cost and total revenue will be more, right? So this is how we can identify the break-even analysis. In simple words, the break-even point can be defined as the point where total cost or expenses and total sales revenues are equal. So when the cost and the sales are equal, then that point is known as break-even point. So break-even point can be described as a point where there is no net profit or loss. So at break-even point, so company will not get any profit or no loss. The firm just breaks evenly. Any company which wants to make abnormal profit desires to have a break-even point. Graphically, it is the point where the total cost and total revenue curves meet. And lastly, we have this ratio analysis technique. It is used to judge the financial performance of a company. Ratio is computed by taking the proportion of one financial variable with another related financial variable. The calculated ratio helps to make proper decisions. Financial variables are collected from financial statements such as profit, loss, and balance sheets. So ratio analysis also helps in preparation of budget because different ratio act as a guide for determining budget figures for different activities. Okay, thank you.